today's topic is about topic 5. And here's the presenters in our group who will be demonstrate this presentation. In week 9, we have learned a new accounting for equity investment, which was equity method. But in fact, experts thought choosing equity method over consolidation to treat some similar investment in a clear situation, which leads to managers can obtain benefits privately to hide the underlying economic truth. So in this presentation, we're going to explain how managers can benefit from choosing equity method and what mechanisms could be implemented to prevent the potential manipulation. Ultimately, discussing whether it is more desirable to require uniform treatment for equity investment. And here is the first question, is to provide a comparison of consolidation accounting to equity method. But the definition of consolidation and equity methods that they are both types of investment accounting. There were some typical differences between these two methods. Consolidation is used for incorporating and reporting the financial statements of owned investment, which means an aggregated consolidation involves combining the financial statements of the individual entities in a group. Therefore, it assumes the parent has controllability and often owns more than 50% of the subsidiaries' voting rights, which means investors has power to arrest to variable returns from its involvement with the investee and has the ability to affect those returns with using its power. Conversely, the equity method is recognized as an accounting used for intercorporate investments, but only records investors' share of profit or loss after tax. And rationale is to spread risk across multiple investors. Equity method is used when the investor holds significant influence or joint control over the investee, but not for control management. And significant influence exists when the company owns a stock value about 20 to 50% in another company. Thus, the proportion of shares in the equity method is lower than that in consolidation accounting. Moreover, the working process of these two methods are different either. Consolidation is used the line-by-line method to record in worksheet, but equity method does not because it only records investment in associate or joint venture as a cost, which means consolidation will lead to higher assets, liabilities, revenue, and expense, but final net income is the same between the both methods. And elimination adjustment was utilized for consolidation but not exercised in equity method. The reason could be parent company will report the investment in subsidiary as an asset in balance sheet, and subsidiary will report the same equity owned by the parent on its account. So in consolidation date, adjustment entry should record the elimination to ensure no double counting happen. Instead, when applying equity method, investor will record the initial investment in associate or joint venture as a cost. Investees put acquisition profit or loss accounts in investors' proportionate share to increase or decrease. And dividends paid by investee are deducted from the share of distribution. And the last difference is goodwill will not recorded in consolidation, but not in equity method. What these two accounting methods have in common is when investors determine the consideration to pay, they will both do the acquisition analysis to consider the difference between the carrying amount of the assets and the liabilities and their fair values, or to make appropriate adjustments. Consideration accounting and equity methods should both eliminate the unrealized profit in adjustment entries after tax effects.
After analysis by managers, they often found it advantageous to invest in other companies without necessarily taking control of them, since they can benefit from choosing equity method over consolidation method. I will explain some major reasons for why equity method is preferred in this part. Firstly, a manager may prefer the equity method over consolidated reporting to enhance its financial ratios. This is because although consolidation method leads to higher assets, liabilities, revenue, and expense, the net income is the same under both methods. Therefore, the return on assets and return on equity will be lower if consolidation method is applied. Since managers are nearly aware that managers of return can strongly affect investors' perceptions of the underlying value of their firm's publicly traded stock, they would use equity method to pretend a higher return on equity and higher return on assets in order to raise enough capital for operating. Additionally, some managers receive managerial compensation based on how they achieve their goals. If they set a particular goal on return on asset or return on equity, when there is a transaction related to investment, they can achieve their goal and get the managerial compensation more easily by adopting equity method compared with using a consolidation method. Moreover, some companies have contractual provisions, for example, debt covenants, based on ratios in the main body of the financial statements as well. Meeting the provisions of such contracts could provide managers strong incentives to maintain technical eligibility to use the equity method rather than full consolidation. Secondly, managers may prefer to accept equity method since the process of recording and reporting is much less complex than consolidation method, even they know consolidation method should be more accurate. The main thing that equity method requires is only to increase or decrease the profit and loss into investment account with dividends deducted from the account. Moreover, the equity method is referred to a one-line consolidation because the use of this method allows recording the net effect of consolidation in one-line income statement as investees in net income. The investor need not to show each adjustment containing revenues, expenses, goodwill impairment, or amortization separately. Similarly, the net effect of consolidation in balance sheet items is shown in single line, as in investees' balance in assets and liabilities. The essence of the equity method lies in the one-line consolidation only, which also significantly decreases the complexity of recording and reporting. In addition, for equity method used by a company that is not a parent, it even does not need to record the cumulative effect of previous profit and loss or other comprehensive income. Therefore, for the same salaries paid to managers, they may only consider to benefit themselves to reduce the workload, which implies the acceptance of a method with a lower level of difficulty, and that is equity method. So if the determination of control and significant influence is unclear, managers may prefer to determine that the company only has the ability to significantly influence the investee, since it would reduce their workload, even they know a consolidated financial statements would more accurately and comprehensively reflect the true financial position for the company. Eventually, managers may seek to hide their quantity of negotiation for the consideration transferred to investee. To understand this, we should first introduce a function for goodwill. Since goodwill reflects the money paid for acquisition above the market value of the invested company, it can signal overpayment and reckless spending. As goodwill is not recognized separately from the investment under the equity method, the signal for how much the investor has paid above the net asset of the investee is concealed. Suppose that the manager was paid by a large amount of money to negotiate with the investee for the price of the investment or consideration transfer, but the manager was too lazy to negotiate, so that the consideration transfer was $5 million in acquiring some shares from the investee whose net asset only worth $1 million. The manager may hire the free lunch, that is, being paid for negotiating nothing, by switching consolidation method to equity method, since the boss would not see how much the goodwill is. In other words, how expensive the consideration transfer is above the market value in equity method.
Well, based on some manipulation mentioned before, in this part, I'd like to talk about some solutions that can be implemented. Firstly, nowadays, many managers are likely to enhance financial ratios of their company, which means they will control voting shares at 20% to 50%, and then they can achieve off-balance sheet financing. And as for the off-balance sheet financing, it means the assets and liabilities of invested company do not need to be displayed by the accounts of investors. As a result, some financial ratios such as return on asset and return on equity look very positive. However, this reduces the transparency of financial information and increases the risk of investment for investors. Thus, there are two measures to regulate off-balance sheet financing. Firstly, it should improve the oversight of balance sheet financing. It refers to establishment of an effective regulatory mechanism. For example, financial departments such as banks should keep abreast of fund trend of a company, supervise financing behavior, and find out the balance sheet financing problems in time. Moreover, they should guide companies to carry out reasonable balance sheet financing, so that the purpose of balance sheet financing is limited to reducing financing costs and adjusting asset structure. And secondly, it should enhance audit of balance sheet financing. Since the balance sheet financing is not included in the balance sheet, the final report issued has been affected. Thus, it's necessary for auditors to further investigate a balance sheet of a company and not to be limited to the information provided by the company, and to research hidden information of balance sheet financing. Thus, it contributes to the users of financial information to realize the real financial situation and make correct decisions. Secondly, since equity method has fewer steps compared with the consolidation method, many managers can choose equity method in order to decrease their workload. However, this decreases the accuracy of financial performance. Thus, an effective measure to solve this problem might be that limiting the scope of the equity method and encouraging the use of consolidation method. To be more specific, the investor and investee can reach a consensus that when the joint control and significant influence are not clear, if proportion of investors' investment is very small, the investor can use the equity method as the accounting method. Otherwise, the consolidation method should be adopted. Thus, this can be a good way to reduce managers' lazy behavior. Thirdly, since goodwill is not recognized separately from the investment under equity method, many managers can take advantage of this provision and conceal actual amount of consideration to make private benefit. Thus, in order to address this problem, an effective measure might be that the investing company must disclose the amount of new goodwill when doing acquisition analysis. So the company's decision makers will have a clear idea of the actual amount of goodwill generated. As a result, there is no free lunch anymore for managers.
I don't think it's more desirable to require uniform accounting treatment for equity investment, regardless of investors' level of influence on investee. Even though the equity method has some defects for implementation, the two approaches can also be complementary. Only by choosing the most appropriate way in each situation will the company's accounts be cleared. In addition to what we mentioned before, stock ownership is a general rule of thumb. When holding different amounts of shares, we need to use equity or consolidation method, respectively. As the equity method can be an essential method, we will then discuss the influence of some non-quantitative factors on firms' choice of accounting method in investment by analyzing the two sides of both methods. First, the equity method only accounts for investment as an asset and accounts for income received from the subsidiary. However, consolidating the financial statement involves combining firms' income statement and balance sheet to form one statement. Apparently, even the consolidation method with accuracy is more complex to prepare reports with the consolidation method, especially for recording. Under this situation, large companies can choose either method they like. In contrast, some small companies may do prefer equity methods more than the consolidation method because the equity method will be easier and cheaper to implement. A more flexible process allows them to start with the next step quicker. Second, a consolidation statement reflects lots of information such as enterprise group's financial situation, operating results, and cash flow. However, if the company needs to know the profit and loss of the investment to make business decisions, the equity method could be a better choice for some companies. By utilizing the equity method, investors can directly add or deduct profit and loss in investment account. In this way, when company compares initial and final accounts, the profit and loss of the investment can be judged with one glance. As for the consolidation method, as everything is combined, so the sector-specific analysis is difficult. In conclusion, we first we first determine the similarities and differences of both equity and acquisition method. The main differences are the proportion of shares investor controlled over the investee and the working process, while the key similarity is the determination of consideration. After that, we figure out that managers can privately benefit from choosing the equity method because the equity method can help them to gain managerial compensation, reduce workload, and conceal evidence of overpayment. As we also give the several solutions to mitigate the potential manipulation, such as establishing the regulatory mechanism, reaching a consensus between two companies, and disclosing the amount of goodwill. Finally, we reached an agreement that it's now more desirable to use a uniform accounting treatment for investment, as these two methods have advantages and disadvantages, and they can complement each other. These are our references used for presentation. That's all for our presentation. Thanks for listening.